picture. We're talking real money.
It's important conversation time here. It's the Talking Real Money radio show and eventually podcast. Hello, everyone. I'm Don McDonald. My volume's a little low because I was trying to fix my tie line thing. And is that better? Yeah, I think that's better. And we hope you call us, 855-935-TALK, 855-935-8255. It's free, it's easy, and we'll talk about all the stuff that impacts your financial life. Like, let me give you a scenario, Tom, and all of you at home. Let's say, kind of like today, inflation is at 4%, okay? It's about 4, right? 4 and something.
I thought it was 3.5 or something.
Okay,
But we'll go with 4. We'll humor
we're
you.
rounding.
Yeah,
We're
it's
rounding.
Saturday.
We're
Let's
rounding.
be nice.
We're
sure.
rounding.
Yeah.
And your boss gives you a 2% raise. Okay.
He's not here. I don't know if I'll get it.
Well,
so
you may not.
I'm trying.
Alternately, your inflation's at 2%, and your boss gives you a 1% cut in pay.
Which sounds better.
Which would you rather have? Do you want the 2% pay raise or the 1% pay cut?
That's a tricky one, huh?
You pick. Go ahead. Which one do you think you should take?
I'll take
I'll
take door number 2, I think,
we
on
can
that
tell
one.
you what the vast majority of people in the country tend to think. In the world. Yeah. In the world. It's not just in the country. It's people in general. We'd rather take the raise.
I know.
Even though, in that scenario, we would have less spending power, Tom.
It's a funny thing.
Our brains.
The author of this, our brains. The author calls this a money illusion. I love that.
Yeah.
I think that's so smart because we had a lot of them. I hate to break it to you because after I read it, and I did have to read this piece a couple of times.
Well, yeah, because it's cerebral.
There's a problem. I probably should have somebody read it to me.
It's brainy.
But listen to this. It's actually
a New York Times piece.
Shocking about this. March 2021 dollar is worth less than 85 cents today.
Wow.
Did that surprise you?
That number did surprise me a bit. I didn't think it was that bad, but we did have some really extreme inflation coming out of COVID. And
then the author says, and I was working then, he had a full-time job in the summer of 1977, as did I, by the way. He said his first job is only worth 19 cents. The dollar he was making then is only worth 19 cents in today's dollars. That really shows you what inflation
it does
in a lifetime or so. I mean, it's kind of shocking. And why do we care about all this?
Because money is an important part of our life, and we're all really confused about it. We don't look at money realistically.
That's why.
We live in an illusory world about money. And I have a theory. I have a theory. I don't know if it's right, but I have a theory. And my theory is that as a species, we've got several million years of history behind us. Yet only for about the last 8,000 of those years have we ever dealt with economies. With trade, with moving money between one person and another.
Otherwise, it was hunting, gathering.
Yeah, hunting, gathering, and staying alive, staying alive. There was a lot of Saturday Night Fever. Staying alive.
Speaking of 1977. Yeah. Good one. Yeah.
But I don't think we really as yet understand money. And think about the last century, just the last 100 years. We've developed stock markets, really, that didn't exist for anybody but the rich.
Other than the tulip trade of 300 years ago. It
didn't exist for anybody but the rich. We have global trade, which really didn't exist much. Everything was local. It was in your community. So these are all concepts that are, I think, taxing for a brain that has not evolved to handle these more complex concepts. My theory. We have weak little brains.
Yeah, and it's important because once you've allowed yourself to be taken by these money illusions, you make mistakes. I'll give you another one because you've heard about it lately. that stock markets are at record highs. Now, the number is a record.
Oh, I had this argument with somebody last night.
But it's not the real number. Anyway, it's pretty fascinating.
The real number, based on a lot of stuff and inflation. Yep. Inflation's part of that. 855-935-TALK is our phone number, 855-935-8255. Stop by. We're talking about money with you. We'd love to talk with you. Call now.
Tom and Don are talking real money.
In medicine, a second opinion might save your life. With investing, a second opinion might save your future. The trick is getting one without a high-pressure sales pitch. Well, I'm Don McDonald, and if you've been listening to Talking Real Money, you know that our goal is to help everyone create a brighter future by investing and managing money better. That's why, in addition to helping everyone on our show and podcast, we are also committed to making our 100% fiduciary advisors at Appella available to help everyone make the best financial decisions based on science. So if you're being pitched a financial product or a system, make sure you get a second opinion with no cost, no obligation, and no annoying sales pitch by going to TalkingRealMoney.com or call 800-386-3004. That's 800-386-3004 or TalkingRealMoney.com.
Your guides to a really great financial future. Tom and Don are talking real money.
I'm still sitting here. I changed my mic out, so you may notice.
You sound kind of muffled.
Do I sound better now?
A little bit.
I don't know if
not perfect though.
Yeah, I don't know if it's the machine, the tie line. I think it may be the tie line,
or it could be.
Could just be
operator.
Me. Could be.
Just put it out there. So,
I don't want to say for sure. And make sure that
you sound a little distant. It's like our relationship at the beginning.
Gosh,
there you are.
Okay,
Better
there we
now.
go. A compressor was on. There was a compressor in line, which compresses.
I don't know what that means. Okay.
It's
I just walk in and start talking.
Is that better now? Less muffled?
Yes.
Didn't know the compressor was on that channel. How weird. Okay. You see, this is live. This is a live show. Today we're talking about illusions, which are live too. They're part of our lives. We believe things, particularly about money, that aren't true. Like a raise is better than a pay cut when it might not be in terms of your spending power.
Or, more importantly, and I love this example, the stock market at record highs.
Yeah. I mean, it's actually at
it
record
is the number,
highs. Yes,
but
not the total return.
Yeah.
Yeah.
And also
with inflation.
When you consider inflation, it's not at a record high.
Yeah.
So
it's very frustrating to be a regular. I can see why people get so frustrated about managing their money because it's counterintuitive in many cases for us. You know, a raise is a raise. A raise is good. Stock market goes up. That's always good. It's not always good. And there are other illusions out there.
Oh, boy. When you gave
Tom
me this piece, as I said,
he loves it when I give him something with meat like this. He's like, what am I going to do with this one?
Let me throw a couple at you, see what you think. Here's another one I think. When you have lots of money in a savings account that's paying nothing and thinking you're rich.
Well, wait, okay, hold on. You're rich, but
I knew you were going to take umbrage with this.
Yeah, you're rich, but you're not making any money.
And you're not going to be rich for long because what you're losing to inflation,
true.
And you're giving the money to somebody. They're taking it and investing it.
I got a better illusion in your example.
Okay.
The better illusion is you've got money in the bank and you think it's safe.
Okay, there's that. That's safe because you're losing money safely.
You think I'm not losing any money. Yeah, I have 4% inflation.
Yeah.
As a matter of fact, it's as bad as the people say, well, look, I lost 4% in my bonds. Well, if you have a 0.1% savings account at the bank right now, you're losing 4% on your savings account.
Thank you. And that gets right back to your pay increase with that 2% with inflation of 4%. That couldn't be more. Okay, how about this one?
Yeah, I'm ready. Go.
Because I see it a lot. You own a few stocks that have gone through the roof.
Okay.
And you think you're rich. I'll give you another example.
Again, is the word
I'll give you an
rich,
example.
or you think you're smart. You think you're smart.
whatever.
I
gotta
change the language of your illusions.
That's fine because
you've got a few stocks that have gone way up, and you go,
right.
I am a day trader, dude.
Yeah. Well, I give you an example because we've run into a lot of people
Kathy Wood.
this year with Tesla. And Tesla's
Tesla
now
Bull.
lost 40% of its value. Tesla Bull, there's others, trust me, that are coming out of the woodwork. So I think that's a good one. Here's one. Now, maybe this is better.
I'm going to have to change the wording on it again. I can just feel it coming.
No, I think this one's better.
All right, go ahead. You got the, okay. Go ahead.
You're earning a lot of money, and you think it will always be that way.
Oh, good. That's better. Because I thought you were going to say,
I thought you might
you're
like that.
earning a lot of money, and you think you're rich.
And you think you're rich. Because that one, it happens all the time. It's happened to me. It's happened to you.
Anybody who's old, not anybody, but the vast majority of us old people, we know that's not true because you're moving along. You're going, this could never go wrong. Never go what? Mm-hmm. It went badly.
Yeah. And look, right now you're
Why did they lay me off? I was the perfect employee. I was making them money.
All these kids getting drafted by National Football League teams that think I'll always have a lot of money.
Oh, yeah.
Sorry.
Just a quick message to all of you who have been drafted so far and those who will be drafted in the future. When you get that first big check, particularly you high in the draft people, when you get that first big check, don't spend. Continue to be poverty-stricken. Continue to be a poor college student for a while.
That's smart. Yeah, try that.
I know mom and dad are saying, son, buy us a house, please. No, you invest it.
There's an idea. Yeah, don't buy a house. Don't get an entourage. Don't start spending up a storm.
And, make sure you get somebody who actually knows how to invest, not gamble, but invest. Please.
And doesn't invest you in, let me think, really wacky. I remember there was that Sports Illustrated piece a decade ago.
Oh, yeah. I mean, where John Elway got taken in by a Ponzi
where
scheme.
The guy invested in rafts you put in your living room so that when the flood happens, you can put your furniture in there and it goes down the river and your furniture stays there. That's a true story.
That. I remember that Noah's Ark Incorporated.
Whatever the name, the money went right down the you-know-what.
Down the stream?
Yeah, something
without
like
a paddle?
That. Sank to the bottom. How about this one?
Okay.
Is this a money illusion?
I don't know yet.
You look at Zillow every day to see how much your house is worth.
Really? Do people do that?
Oh,
so it's like the stock market? Really?
All the time.
And the other version of that is you look at the stock market all the time.
Oh, yeah. And you're sure you're wealthy, which maybe you are for that moment.
But the thing is,
Zillow,
at least about looking at the stock market, you're dealing with actual trades.
Well,
not
and you
Zillow
can get the money.
Guessing.
Well, and you can get the money. With Zillow, you've got to sell the place. You got to pay whatever's, you got all the expenses. So it's not that
ask
number.
My daughter, sometimes they don't close on time.
She's waiting on the money.
She's waiting and she's going,
beautiful St. Augustine.
I have to make another house payment.
Oh, well, yes.
With it empty?
The short answer to that.
All right.
So those are more illusions.
Do you have any more?
No, because you've already shot down all the ones. You come up with a few.
I just renamed them. That's all I did. Actually, pretty much everything we believe about money as a group is kind of an illusion. The biggest illusion of all is thinking that you are doing something to make money in the short run and confusing that with investing. That may be the very biggest of them all because that's the thing we see the most. We hear from people who are buying individual stocks or trying to pick the right mutual fund or are, I'm feeling like the market is at an all-time high and I think I'll take my money out and sit and wait until it feels better. You think you're an investor, but you're lying to yourself. You are not an investor. You are absolutely. I know you don't. And here's the thing is that I know as I say this, not literally, figuratively, thousands of people are putting their fingers in their ears and going,
not me. Wasn't me. Didn't do that.
No, you are not investors. You're not. You're a gambler.
Speculator.
Admit it. If you are speculating, you are gambling. They are synonyms. Not synonyms. Synonyms.
which would be far better and tastier for this program. But yeah, so those are all things that we think we have right, we don't have right, and it's kind of the reason we're here every week, right? To try to help you understand the difference.
Cinnamon just reminded me of a story.
Oh, please.
It's a great story. My daughter, when she was, this is Tori, when she was, I think about 4, just learning to read, not good yet. Maybe, I don't think she was 5 yet. Debbie used to make her French toast they used to make French toast together on the weekends. And they made some French toast up, and Tori goes to get the cinnamon because she loves the cinnamon on her. So she sprinkles the cinnamon on everybody's French toast. So we're taking bites going, she goes,
is there any toast?
She goes, I got the cinnamon. I got it right here. It says cinnamon pepper.
Cayenne pepper.
855-935-TALK.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
We love it when you call us at 855-935-TALK, 855-935-8255. And we have 3 calls lined up now. 3 calls.
You're a little hot now, by the way. Now you're too hot.
I just don't know.
Hot, you're cold, you're all over the place.
I have to send the tie line in to be repaired.
That's unbelievable.
It's $1,000 repair.
That's
$1,000.
I hope that's coming out of somebody else's pocket.
It's not mine.
Okay.
Anyway, we have people from all over the country. In fact, one of the places I'm going to be really close to on my summer trip.
Yeah, which is available now online at talkingrealmoney.com.
Yeah,
Check
I got the first half of the trip, I got the eastern part of the country. And I'm going to be close to Westchester, Pennsylvania, where Lonnie is.
Which is where the call.
Lonnie, welcome to Talking Real Money.
Talk more about that. Lonnie, go.
Lonnie.
Hello, guys. First, I would like to say that I'm a huge fan, and I try to turn anyone onto your program that I can.
Oh, thank you.
Found out you guys on a commercial on the Clark Howard show years ago.
There you go. Good old Clark. We got to love him.
Another amazing.
Yeah, we love Clark.
Another amazing advocate for the consumer, just like you guys.
Yeah,
Thank you for that.
Thanks, Lonnie.
Sure. So here's my question. I have a special needs brother that has recently become my financial responsibility due to the passing of our mother. Mm-hmm. And he's okay to live on his own, and I got him set up in an apartment, which costs about $2,000 a month. He gets Social Security disability, and that covers like his food and his clothing, but not the housing. And my mother put me in charge of a trust. So basically I have $500,000 to cover his housing expenses for what would be, I guess, the remainder of his life. Mm-hmm. He's 44 years old and in decent health. So really my goal is to try to preserve the principal so that it can last him in the remainder of his life. And also, the second goal is just to cover that expense indefinitely is really what I'm looking to do. And theoretically, I said to myself, if the money market would just pay 5.25% forever, then that math would probably work. But
it would.
No, there's no guarantee of that.
But it won't.
There's no guarantee of that. So exactly. So that's why I'm here, and that's why you're here.
Yeah, I mean, here's the thing. In a general sense, we can tell people, look, if you take 4% a year out of the portfolio, it should sustain itself. But when you start at age 44, that's a long way for that 4% to last. So
and
therefore,
it goes back to our original story about
it does.
The purchasing power of that money eroding over time.
Yeah.
So every year that $2,000 in expense plus, Social Security disability will keep up with inflation, but that $2,000 in housing, that is going to go up by 4 or 5% a year on average. Or
I would be tempted to do something. At least
I can tell you what I'd be tempted to do.
Okay, you go ahead. You go first, because this time I can pick on you.
To make it really simple, because you want him to be able to run it when you're not there. And that is to go to somebody like Vanguard and set up a target date fund.
Yeah, but remember, isn't that what they had the problem with in the taxable accounts?
They did, but they're not going to let that happen again.
I hope not, because that is a good
even if it
solution.
does, he's in a low bracket.
That's true. So
he's
even
in
if
a
they
non-existent bracket. So what you can do is get a target date fund and set up a systematic withdrawal.
Which one?
Well, I would probably be more conservative than his date of retirement year, quite a bit more. I mean, his date of retirement year, that would put him in a 2045.
2045.
Yeah, I would probably do a 2030 or a 35.
Because now you're going to have
it'll be
60,
a 50,
40,
50, 60, 40 right about, probably 60, 40 right about now. But getting more conservative with time, which is what you want to do, because you'll always have a tiny little equity component in there to help grow it and possibly beat inflation.
I love the automation. I love the fact that the money comes out all the time regularly then. And I love the fact that it doesn't require you, Lonnie, to be involved in it day to day, which could be problematic if you can't do it. So I think that's a very reasonable solution. Sure.
Would I just take monthly distributions from that then to cover the rent?
Yes, sir. That's what you do. You just
because they're going to rebalance. They're rebalancing the account inside.
They're constantly
anyway.
rebalancing it.
Yeah.
So you just take out what you need every month, or take it out every year. What I would probably do, because of the volatility of the market, is go ahead and take out the $24,000 at the beginning of the year. Put that in a money market or a high yield savings account based on whatever the current rate is, and then pay the $2,000 a month from that, and then next year take out another $24,000 or $25,000 depending on what inflation's done. Because remember, you're going to adjust the 4% for inflation. That is basically the 4% rule. 855-935-TALK.
Tom and Don are talking real money. Reality radio for a really great future. We're talking real money.
Hey, everybody. Welcome back to Talking Real Money. I'm Don McDonald. Tom Cox over there. You're there. We're glad you're there. We hope you'll call us, 855-935-TALK, because guess what? We're really talking about real life, because money is so big a part of life. And now let's go to Massachusetts, where Mike hangs out. Hey, Mike, welcome to Talking Real Money.
Hello, gentlemen. I love your show.
Thank you, sir.
I'm one of the old people you were talking about earlier.
Welcome to the club there, Mike.
It's a good club.
Yeah.
All right.
I'm collecting Social Security and a pension. My wife's a few years younger, so that she's working still, but in a year and a half, she'll be stopping. And
so you're a kept man, basically, is what you're saying, right?
I want that deal. How do you sign?
Exactly.
Is there a place?
Yeah.
There's a place to sign up for that somewhere?
You're dreaming again.
Well,
way illusion.
I guess my main question is, should she take Social Security? She'll be FRA when she retires. We will need that in order to cover all our expenses. Or should we wait till she's 70 and she'll probably get $1,000 more a month? And should I just take the money out of my IRA? I guess that's my basic question.
Well, okay, the basic answer is there should be planning involved before you make that. In other words, everything should be put into some sort of software and look. But in a general sense, you can do the math yourself, right? Because every year she waits after full retirement age, she's getting an 8% a year raise plus inflation, which is going to be very difficult for you to make in your investment accounts. We don't know very many people that make 8% a year.
Do you have other monies that are not in an IRA? Other investments?
I have roughly $100,000 in money markets.
Okay.
And how long will that pay the bills?
That'll pay the bills. If you're
right now, I'm not touching any of my money in the bank or my IRA.
But no, the question would be: when
she stops working?
Yeah, when she stops working, will that 100 get you between full retirement age and age 70 with all the other money you're taking in?
By my math, it's going to be really darn close. Really, really close. I see without any growth on that 100,000, and it's going to grow. Hopefully you have it in a high yield account of some kind. By my math, at $3,000 a month, if you have to cover a $3,000 a month deficit, which sounds about right based on the fact that she's going to get another $1,000,
you're there.
Then you're there with that 100,000. And then you just start replenishing that as you withdraw from the IRA.
Is probably a good idea.
Oh, waiting is a great idea.
Okay.
Yeah, it really is. And it's
such
the
a
math
no-brainer.
is so
bump. Yeah.
I'm waiting. I mean, I'm walking the walk. I am FRA right now. I'm not touching that stuff.
Gotcha.
It's an extra $1,000 a month for the rest of my life.
Right.
I mean, we are
right.
talking real money now.
Yeah, and one other question as far as Roth. I got in late in the game, so I have probably, I don't know, 30 in my Roth. And I just started one for my wife. I don't know if that's smart or not, but I like tax-free money.
It's not dumb.
So I'm just curious, what would you invest? Would you be aggressive in the Roth?
Yep. I'd put that all in stocks. I'd use one of the one fund global equity funds we talk about, whether it's Dimensional's product, DFAW, or Avantis's AVGE. Either one would be very fine. It's globally diversified. It has a tilt to small and to value, and it's very inexpensive.
I, on the other hand, would not be that aggressive.
Okay.
Why not? It's a small amount of your money.
It's
sure,
a small
why not?
amount, but it could,
right.
over time, because he doesn't need to take risk. You see, they're going to be set on their Social Security and their pension.
He's never going to spend that money, is my guess.
All right.
So that's
all right.
going to
be as aggressive
growing.
go take the risk quiz at talkingrealmoney.com. See how crazy wild you are.
Okay.
Okay?
And as far as my IRA money, one more question, if possible.
Yeah.
My IRA money, I really have, it's all in equities, and I don't have bonds. Is that too risky?
Yeah, but again, this all gets back to where we started the conversation, is if you had a plan that says, here's how much we need to make on the money, and you knew how much risk tolerance you had, like Don talked about the risk quiz, that would resolve the stock-to-bond ratio.
Yeah, see, we really believe that plans are necessary at any age, but when we get to our age, they're critical. You got to have at least some kind of a plan and then know your risk profile.
Tom and Don are talking real money.
Do you suffer from hodgepodgeitis? I'm Don McDonald, and hodgepodgeitis is a disease of your investment portfolio whose symptoms include lots of stocks, loads of random loaded mutual funds, and maybe an annuity or two. Most who suffer from hodgepodgeitis dread opening their quarterly portfolio statements. They feel lost and confused. Investing seems overwhelming and the financial future uncertain. If you believe you suffer from hodgepodgeitis, see a 100% fiduciary investment advisor immediately. A proper diagnosis is the first step to creating a portfolio with a purpose based on a personal plan. Start on the road to recovery now by scheduling a free meeting with an Appella advisor at TalkingRealMoney.com. There is no cost, obligation, or high-pressure sales pitch. Take the first step at TalkingRealMoney.com or call 800-386-3004. Hodgepodgeitis is not a real disease, but treating it has been shown to improve mood, reduce fear, and even lead to a brighter financial future. Results may vary.
Your guides to a really great financial future. Tom and Don are talking real money.
Hey there, welcome back to our little get-together that's a money show. I'm Don McDonald, Tom Cox there. Thanks for being there listening. And our phone number is 855-935-TALK. Gilbert, Arizona is our next stop. Donna, welcome to the show.
Hi, Tom and Don. I've been talking to you guys in the past about going from hodgepodge to minimalistic in my portfolio.
Good job.
And, at one point we talked about, going 70 VT, 25 BNDW, and then the other 5% in AVUVX to get a little small cap in there. My thing is, I still I've got a high risk tolerance. I'm always in accumulation mode, even though now I'm 67. I've got a comfortable retirement. Don't need to touch Social Security until I'm 70. And, I should probably be more sensible and maybe more preservation-oriented. Can you talk me down out of why I always have this need to accumulate and take risks when I really don't need to?
Because you're suffering from money illusion. No, I don't know. We don't know. That's digging inside your soul to figure it out.
That's way beyond our mandate. We did not. Neither of us got a degree in psychology. Darn it.
Yeah, we should have. Here's the thing.
Is it hurting you?
Yeah.
I mean,
if
really,
it doesn't bother you, what do you care?
No harm, no foul.
It's just I'm thinking it's not real. It's not sensible, really. It's unrealistic.
No. Now, actually, let's look at it this way. It's really sensible to not have a portfolio that's entirely made of equities is actually dumb. The only reason we suggest people do it, or it's dumb based on the past. Now, we don't know the future, but based on the past, the smartest thing any investor could have done was to own the entire global stock market. That would have
only stocks, no
only
bonds.
Stocks. It would have been a brilliant move. The only problem is 2008s. When they happen, then
87.
most people freak out. If you are absolutely certain you are a non-freak out person, then it's the right portfolio for your risk tolerance.
And what did you say your stock to bond ratio was? I couldn't quite make it out when you mentioned it.
Well, I was saying 70 VT, 25 BNDW. So
BNDW, the world BND.
Ah, okay,
the
so
global BND.
Okay, so you're basically it's 75.
Well, no, it's like 80-20.
Yeah.
Which isn't outrageous.
5% of AVUVX.
No, what was that again?
Was it
AVUV? AVUV?
AVUV 5%, yeah.
Yeah, okay. So 75-25, roughly.
There's no exact right number. There is only the number that fits you, as Don said, your risk tolerance. And if you're comfortable with seeing that portfolio drop by 35% or so at some point, then that's okay.
If you sit tight. And
I've tolerated history a few times, so I don't see why it would be any different now.
Then you're proof that you're doing it right. So stop worrying. Be happy. Go crazy. Don't go crazy. Just keep doing what you're doing. It's a very sensible portfolio because you own the world's economy.
And you've already said you have a plan in place as to when to take Social Security. You need to know, you know all those things rather than shooting in the dark. So you've thought them through. That's very important. So I'd say congratulations, Don.
I would too. I think you're on the right track, Don.
Yeah. Guys, thank you.
You're very welcome. Thank you. Thanks for listening. 855-935-TALK. And Michael in Seattle, you're up. Welcome to the show.
Gentlemen, thank you so much for taking my call. Question on targeted funds, or I listen to your show regularly. At what point in time, let's say from a money standpoint, portfolio value? I understand if you retire and you're healthy and you have 25 years to live, if you and your wife. But what happens, if you have $500,000 in savings? That's one thing. You can't afford to lose 35% in a year. But what number do you say? No, you know what? You're going to live another 25 years. You have this X amount in savings. You can afford to ride out a 35% drop and not even notice it. So stay 100% in equities.
It's not the right question, because it's not a matter of whether or not you have enough money. As we just said to Donna, it's not the money, it's the psychology. It's, many of us, if we're relatively frugal, at any amount of money, we could conceivably have enough to ride out a bad market where the worst case has been about a 50% decline if you were 100% in stocks. So if you could stand that, then you're in the right place. But it's, we usually come back within a year or two, but it's got to be the psychology of it. We don't want people to do dumb things when the market declines. That's why we suggest better balance.
And I will add one caveat, Michael, that because you mentioned target date funds, which hold some bonds. The reason that you want bonds when you're withdrawing the money is that's the stable part of the portfolio. So no matter what happens in the stocks, you can provide the income without having to worry about this volatility. So Don's right. In the accumulation phase, sure, go ahead, take all the chances you like. Should look a little different when you're starting to take that money out because you need more portfolio stability.
But again, know thyself. You gotta know what your comfort level is. Really, truly sit down and think about it. Imagine you've got $500,000 or $1 million or $2 million laying on the table. Let's imagine $2 million, because you said a lot of money. And let's imagine for a moment that someone walks in, grabs $1 million and starts to walk out the door. And says, I have always brought this back. You can ask everybody. They'll tell you, I've always returned the money I took away, but I can't tell you exactly when I'm going to return it, or absolutely 100% sure that I will, but I've always returned it in the past. Are you comfortable with that person walking out the door with your $1 million? Because that's Mr. Market.
Okay.
Mr.
Perfect.
Market.
That's what you got to know.
Yeah.
Perfect. Thank you, gentlemen. Appreciate it.
You're very, very welcome.
He sounded like he was driving. Why isn't he on the new light rail that's open today in Bellevue? I didn't understand that.
Did it finally open?
It opened today, and by the way, it goes from. I
Where
don't
does
want.
it go?
Okay, I'm gonna. This is gonna be. It goes from here
inside Seattle baseball.
No,
Where does it go?
Not Seattle. It goes from here to Redmond, and then it goes back. So it works well. I thought this through. This is really good. If you work at Microsoft and you want to work at Amazon, which is in downtown Bellevue, now light rail will take you from one job to another.
Wait,
so it's perfect.
Doesn't
Or the other way
Microsoft
around.
also have offices in Bellevue?
Yeah, they do.
So you can
That's
go
a
back and
bad
forth.
joke.
But it doesn't
it's
connect to
anyway.
Seattle?
Not yet. That's 2025. They had a problem on the bridge.
Oh, the bridge, of course.
You don't want
They
it to
always
fall
have
off into
problems
the
on the
water,
bridge.
So anyway, yeah, it's coming.
All right.
Yeah, sorry about that. But he laughed, too. Aren't you on the light rail? Anyway.
Let's see. I'm looking at the time going, let's start. What the heck? Kevin, welcome to Talking Real Money.
Yeah, hi, Tom and Don. Hi, thanks for taking my call.
Thank you. What's up?
Can you hear me okay?
Yes, sir.
Can you hear me?
Yes.
Oh, okay, great. Yeah, no, thanks for taking my call. I just have a question regarding an inheritance. It's more of an inheritance question. Now, I'm trying to see how my parents, who are in good health, can transfer money upon their death, bypassing me to my kids. And I'll give you a little background. You know, my wife and I are pretty well-to-do from a lot of hard work and frugal savings, so we really don't.
So you're set. You don't want the money to come to you. You want it to go to the next generation.
I don't want it. No.
Tell you what. Hang on a moment, and we will talk about the way that is done. 855-935-TALK is our phone number. We'll be right back.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
Hello again. Welcome back. I'm Don. That's Tom. We're talking with Kevin about a way to take an estate, bypass the kids, take the parents' estate, bypass the kids, give it to the grandkids. Tom?
That's right. I think you just get a bypass trust.
Kind of, yeah. It's like
elaborate?
an A-B trust.
Yeah, it's exactly what it is.
You just create two separate trusts. The other thing, this is actually the easiest. It depends on how their assets are held, where most of their assets are. They could just, in IRAs, name beneficiaries. They could have payable on death clauses. Transfer on death.
The problem with the
kids,
but then the 10-year rules apply. But that's okay.
On an IRA, on an inherited IRA, sure. But what the heck?
Right.
It's free money.
Yeah. No, I'm not the question.
I'm just saying the easiest thing is, you could do on a lot of accounts, you could do transfer or payable on death, and then it goes right to whomever is named there. You don't even have to hire a lawyer. But you would need a lawyer to do a bypass trust.
Yeah, and we are not estate planners nor lawyers.
So it could go to you, and then it goes into your trust, and then your trust goes to the grandkid or to your kid. Yeah, that was Mm-hmm.
Yeah, so my kids are currently 11 and 13. So let's say my parents pass away today, and then my kids are named as a beneficiary. Me being a custodian would manage their funds up until age of majority, which is, I believe, is 21.
Yep.
And then they would get the money.
Yes.
Now, are there certain ways you can put little restrictions on that money, such as creating a trust and have that?
By the way, because we're running close on time, by the way, your parents could just set up a trust that named the grandkids directly and had all kinds of controls built into the trust. They could just skip you entirely. They wouldn't even have to do a bypass, which gives it to you, which gives it to them. They could just give it right to the grandkids. But again, this is going to require, because we're neither of us this is going to require a good elder law estate attorney to draw these things up. And thanks so much for the call. We really appreciate it.
Great.
All right.
I appreciate it. Thank you.
Real quickly, Rashid, we've got about a minute.
Rajiv, go.
Tom and Don.
Yes,
there he
go
is.
ahead.
Yep. Hit it, man. What do you got? Hit us.
So recently I've been talking to a few people, and one of them suggested index contracts to have some kind of a guaranteed returns and stability and those kind of things.
Oh, okay.
I have never heard about that.
Yeah,
so
it's
I wanted
called,
to understand.
It's called an indexed annuity, Rajit. And it is a high cost. Yeah, it's a high cost product that makes a big commission for the insurance agent and does not actually give you the return of the index. As a matter of fact, what they tend to provide is a payout in line with whatever the current fixed annuity rates are, which right now are around 4%, 4.5%, maybe 5s. They're not magic ways to get the return to the stock market with no risk. If such a thing actually existed, no one would ever invest in the stock market. This is a big lie told by the insurance industry that I wish somebody could regulate out of existence.
30.
But they've done a very, very good job keeping the legislation at bay that would do this. So avoid these things like the plague, Rajit. Thank you so much. And 855-935-TALK is our phone number, 855-935-8255. Give us a call every Saturday from noon to 2 Pacific, 3 to 5 Eastern, and we really appreciate you being there. You want more information? Just go to TalkingRealMoney.com, TalkingRealMoney.com.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appellate Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appellate Wealth, a fee-only registered investment advisor. Please see Appellate Wealth's ADV Part 2A on our website for information regarding Appellate's fees and services. Appellate Capital, LLC, DBA Appellate Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appellate does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. Is anybody still listening?